Following the U.S. elections and the recent Federal Reserve meeting, two major heavyweights for the market have been lifted. But does that mean investors are feeling more comfortable given an overcast of some looming uncertainty? What about the impact on the markets and client portfolios? We're going to break that all down for you and more right here on UBS Trending. Hey everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining us. Brian Ferguson is joining me here in the studio. Brian, great to have you join us. It's been a little while since you've sat here and had a conversation with me, and as we were just saying before, a lot has changed since the last time you were here. Well, so let's kind of acknowledge where we are right now. I mentioned in the open, the election is finally past us. It's been it was a long campaign, and lots of ups and downs and surprises in there. And on top of that, we just had a recent Fed meeting where they took another 25 basis point cut. And so at this point, I think investors are thinking, okay, we know some things, but there's still uncertainty on the horizon. We don't know exactly what a Trump presidency looks like 2.0. Policies could change from what the campaign says to what actually happens. What happens in the House and the Senate could also be up for grabs. There's lots of things out there. So how are you managing through uncertainty and this sort of period that we're in where we've got an active Fed and a changeover in Washington?
The future is never clear until it's in the present. And so with that in mind, I think about Boyd Vardy, who wrote The Lion Tracker's Guide to Life. And one of the things that he talks about in that book is a great lion tracker never knows where he is going, but he knows exactly how to get there. The value in value is bigger now than it was in the tech bubble, bigger than 99 and 2000. That's point one. Point two, though, is that there's never been more value traps in the market. And that's music to the ears of active managers, because you can, unlike a passive portfolio, you can be overweight and underweight. You want to be overweight the beneficiaries where their cash flow and earnings are going up, and underweight those that are going to have stagnant cash flow and earnings. So I have never seen a period where what we see through the windshield, the future, looks so different than what we see through the rearview mirror or the past. Great for active management.
Well, talk about that a little bit more, because as we're sitting here, viewers might think, well, look, we're looking at an S&P 500 that at this point, as you and I are sitting here, is up almost 26% for the year. The Dow is up 17%. You've got Treasury rates finally normalizing on the yield curve, where you've got the 10-year lower than the higher than the 2-year. So they're thinking, where is that value then? If you're looking from a sector perspective, where are you finding the best value in value?
First off, we all know the market has been very, very narrow. So the PE of the marketplace, which is high by historical standards, on the market cap weighted when we look at the benchmarks, but when we look at that equal weighted PE, it's at an unprecedented 6-7 points lower than the market cap weighted PE. And then we can go into the value universe, and the cheapest quintile of valuation in the marketplace trades at about 10 times earnings. So as a value manager, our biggest challenge is we're finding too many opportunities in the marketplace. And I think that would be very different, or a big contrast, from growth managers.
Right.
So a very, very narrow market.
So this is great for you to be telling us, because I think obviously people's ears are perking up and thinking, okay, there's opportunities. Because I think some people look at the markets and think, not a lot of opportunities out there for me. I'd be buying it, it's very top heavy. But from what you're saying, it sounds like there are opportunities there. Does anything that's happened in the last couple of weeks and what we're expecting so our call here in CIO is for the Fed to cut 25 basis points in December, and a total of 100 next year. Not sure if that's what you're all thinking, but are there any changes to your approach given what we recently found out between elections and the Fed and what you expect next year?
Yeah. No changes to our approach, but importantly, the changes that have occurred and that are likely to occur will have, I think, and we think, quite profound impact on business momentum, some good and some bad, for companies across the market. For example, financials. We are overweight financials in the portfolio, both from insurance companies and now from the banks. And on the banks, and that's where we've been building the overweight over the last year after being underweight for a couple of years.
Right.
There are some really big changes. And some of those changes were punctuated and will be perpetuated by the outcome of the election, which would include regulation on the banks in particular is likely to be less onerous than it would have been otherwise. We'll see what the Basel III endgame shapes up, but I don't know exactly where it's going to end up, but it's going to be better than it would have otherwise. Point two, regulation in totality is likely to unleash an acceleration in loan demand, which has been elusive heretofore because there's been a lot of uncertainty. And then the last thing would be related to the regulation and having the clarity. Now we know the results of the election, that capital markets activity, which the banks have a lot of exposure to, as well as ancillary fee income, are likely to be picking up. So good valuation, this is what we look for: attractive valuation, good or improving fundamentals, think quality and balance sheets, and catalyst-driven business momentum. And so the banks, by our judgment and analysis, are right at that intersection, right in our wheelhouse.
Right, right. If you think about, so, clearly what you're saying makes a lot of sense because we've heard, and we remember this from Trump's first term in office, that there was a little bit of more deregulation of the banks. Does that kind of give you any concern that we might see, if there's more deregulation coming with a Trump 2.0, that we could have another Silicon Bank or one of these kind of situations where the bank is failing because there's less regulation on, what they're doing within their own investing and obviously how they're working with their clients and customers? Any concerns there from your side on that?
Yeah, I mean, listen, I think you always have to be mindful. I mean, the fire is never where the hose is pointed. And so, we're going to have to monitor that. But I would say, and even though, yes, you're right, we did have a couple banks, First Republic, Signature, Silicon Valley, that had real existential problems. All that being said, the regulation that is in place in the banks and the capital levels is rock solid. The capital ratios are the best that they've been in 80 years. And the other thing too is we were just able to name a couple companies, the ones that I mentioned, Silicon Valley, Signature, and First Republic. But what we didn't mention was a systemic issue.
Right.
Very different than 2008, and that's because of the fortress capital positions that the bank have currently due to the regulation in the wake of the great financial crisis.
Right.
So we think the fundamentals are rock solid on the banks.
Yeah, that's great. That's great. Thank you for reiterating that. That was certainly a question that came up in March of 2023 when those banks, those couple of regional banks, were failing. Where are we in another great financial crisis risk? And that was not the case, as you said. Correct. The fundamentals are strong, and like you said, the capital that banks are having on their balance sheets is also really strong as well. So we can get really caught up in the minutia and all the details, right, Brian? But if you look at the overall picture, and also we see a Fed with possibly a soft landing, but there are potential cases where we could see inflation maybe kind of hit the bottom and go up again, because we just had CPI come out at 2.4%, which was a little bit above last month's. So if we see a reversal in inflation sometime next year, the Fed may have to pivot. How does that look for you when you're thinking about investing, value investing, say the next couple of years into 5 years when we may have another administration or another party, I should say, in the White House? So much uncertainty ahead. So how do you even manage that?
I think you have to acknowledge that there's multiple pathways that we may end up taking, and it's unclear as to which one we're going to take. And so I think it is important to have a diversified portfolio, to embrace the balance, and to really emphasize value. And this is what we embrace as our investment philosophy, the three legs to our investment philosophy, which is time-tested and kind of all-weather, because these things matter. That's why we embrace them.
Absolutely.
Having the value, having good or improving quality, and catalyst-driven business momentum. Now, where we source that changes over time, and that's why the word dynamic is in our strategy name. So we're going to let the market tell us where the opportunity is. We're not going to tell the market. Currently, as mentioned, a large overweight in financial services, a large overweight in healthcare, but large underweights in utilities and real estate investment trusts. That may change over time, but based on the opportunity set that we see in the marketplace, that's where we're finding the stocks that epitomize and are right in the wheelhouse of our investment philosophy.
Is that pegged to whether or not we'll see rates continue to come down if the Fed does keep cutting, as far as when you're looking at REITs and things like that?
No, it's really not contingent on a macro call such as, well, rates are going to keep coming down. And you know what? I think that one should be prepared that, and I'm not sure it's out of the question, that a year from now, we might be talking about Fed hikes again. Because back to when we were talking about the banks and the improving business momentum, well, guess what? That's quite stimulative for growth. And with growth comes more dollars chasing a finite amount of goods, which the relief mechanism is price.
That's right.
And inflation. So
it's kind of a no landing scenario, isn't it?
Yeah.
That's sort of the definition of a no landing, where the economy gets reignited, but inflation goes up again. So the Fed has to possibly pivot.
So I think that's one of the scenarios that you really have to be prepared for as a portfolio manager, as an investor.
Right. Thanks, Brian. Good to see you.
Good to see you as well.
Great. We'll have you back again soon. Brian Ferguson, Newton Investment Management Portfolio Manager. And thank you all for joining us again. For more information, you can visit our website, ubs.com/views. Plus, you can follow UBS on social media. We're on all the channels, including Instagram. You can follow us at UBS Trending. And as I was just saying to Brian, please make sure if you have any questions or want to talk about your portfolio that you are contacting your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.